you're looking for a balance of that cash flow and appreciation,
Hmm.
it comes down, as anybody who's in the space knows, there's no single factor. You're really balancing the potential risks of the asset and the rewards of the asset. So
Hmm.
sticking with the value add multifamily play, obviously you're looking at market rents, competitive set rents, how much does it cost to renovate the units, improve the amenities of the property, and plugging all those capex inputs in with the purchase price to make sure that ultimately you're creating enough upside and you're kind of
Hmm.
creating that arbitrage in those improvements to drive the value.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Welcome back, Decoding Cashflow listeners. I'm your host, Ted Patel, and today we are joined with Ivan Pulaski, the Director of Investors Relation at Axia Capital, a diversified real estate fund operator focused on recession-resilient assets. With over 16 years of experience in real estate, Ivan has seen it all from acquisitions and operations to capital raising on both equity and debt side. In his role, he works closely with investors to understand their goals and help them navigate the evolving real estate landscape. So, with that said, Ivan, welcome to Decoding Cashflow. It's a pleasure having you on the show.
Thank you, Ted. Happy to be here and look forward to our conversation.
All right. So, before we dive deep into your niche, what do you do? Can you give our listeners a little bit background about yourself? How did you get started into real estate?
Yeah, so I have loved real estate as long as I can remember. When I was real young, I'm talking between 6 and 10 years old, I was living in suburban Atlanta and remember seeing a Publix anchored shopping center getting built kind of around the corner from the subdivision we were living in, and just being fascinated with the construction process. There's land, and now there's something. Fast forward to kind of more of an adult era, have always been good with numbers and have really loved the tangible nature of real estate. And obviously, as a young kid, you don't understand rents and expenses and how you create a return, but I've grown into that over the years. So went to the University of Real Estate or University of Cincinnati for with a business major focused on real estate. Got my first job helping raise capital for a retail operator. And fast forward to today, running investor relations for Axia Partners and really just getting to talk to other investors about real estate day in and day out.
Mhm. That's great, man. So, can you give us a little bit more about Axia Partners? Like, what exactly this company is about? What are their main focus on?
Yeah, so we are a commercial real estate owner operator. We invest primarily through funds. So especially if you have a lot of people used to syndications, we do it through the fund model for a couple reasons. But within those funds, we are really focused on the value add multifamily sector. Nothing unique terribly there,
Mhm.
outside of all the syndications that I'm familiar with, and many of your listeners probably are too. But we also focus, we kind of do a dual approach with RV parks. And one thing I
Mhm.
always say when I talk RV parks, not mobile homes. These are kind of the vacation travel trailer. For many people, it's a affordable second home. And we look for those kind of destination parks where they have water access, they have pools, lodges. We bring in the bands and really help run the hospitality side to help
Mhm.
drive the revenue side by similar to the value add multifamily. We improve the property and therefore can help push those seasonal rents up. But that's
Mhm.
our dual focus is RV parks for the cash flow, value add multifamily for the appreciation, and of course you hope for the opposite
Yeah.
out each. But as we all know, value add multifamily today hard to create any cash flow, at least in those early years.
Yeah, the economy has changed, so let's see how it goes, moving forward. But
It's a little different than
yeah,
it was a few years ago.
Exactly. Yeah. So when you evaluate these potential real estate investments, right? It can be maybe multifamily or RV park, whatever it might be.
Hmm.
What are the main factors that you consider while evaluating those properties?
Yeah, so obviously we're looking for a balance of that cash flow and appreciation.
Hmm.
It comes down, as anybody who's in the space knows, there's no single factor. You're really balancing the potential risks of the asset and the rewards of the asset. So
Hmm.
sticking with the value add multifamily play, obviously you're looking at market rents, competitive set rents, how much does it cost to renovate the units, improve the amenities of the property, and plugging all those capex inputs in with the purchase price to make sure that ultimately you're creating enough upside and you're kind of
Hmm.
creating that arbitrage in those improvements to drive the value. On the RV parks, I'll focus on that because it's probably a little bit more niche than most people are used to. Uh, it's again same ideas, but you're looking at it more with a hospitality lens and an operator lens.
Hmm.
So, um, we learned some lessons. We thought having early in some of our early RV parks, we paved additional pads. Put asphalt on and said, "All right, this is great because it's easier to park. It's easier to get in and out. Like you're on asphalt." That's not the case with RVs. They want gravel because the asphalt pads actually absorb and then push heat up into their RV, so it makes it really hot in the summer. Um, but you're looking for can I add pads, or what's the pool facility like? Is there one? Can I improve it? As noted, we really like what I call more destination type properties.
Hmm.
So we're looking things for some unique feature. Our current RV parks are both on water. One's directly on a lake, the other is on a river that feeds into a lake. And so we have boat ramps to let people launch. Again, it just creates that attractiveness for the property that
Hmm.
helps not only keep the tenant base sticky, those seasonal rentals, uh, but also allows you to sort of drive value because you have something unique that just a field in the middle of nowhere can't offer. Um, but again, it's kind of a mix. Where are those revenue generators? And then how can we control expenses on that side? And typically through capital improvements, even on the RV park.
So now, of course, that's a good niche, right? RV park. Um, but as you mentioned, I think it might be a little bit based on the seasonality also, right? It's more on the seasonal base. Maybe at some point of some seasons, there's a more rush, some seasons there less. So
Mm-hmm.
what's the normal turnover of these tenants? I wouldn't say tenants, but these visitors, I would say, to the RV park.
Yeah. So in ours, we've been able to keep really sticky tenants. So we're keeping
Okay.
over 75% retention. And I don't know that exact stat. It might be north of 80% retention
Okay.
season to season. And you have to remember, while it's not a mobile home, like these are pull your truck up, hitch it up and pull away. They're not kind
Mhm.
of mobile, but really can't ever be moved again. Um, when you're creating that amenity package that they just can't get elsewhere, you you tend to keep a high percentage of the people and those tenants. I will note that it is a lumpier cash flow than most people are used to because we will certainly collect full seasonal rent. The nice
Mhm.
thing is they're basically paying for a year. So, all of it comes down to the pricing, even though they're not paying month to month, even though the season might only be, 7, 8 months long, you're factoring that in on the front end too, knowing that that's your
Okay.
revenue stream. But we will start selling the following year seasons kind of towards the end of the prior year. So we'll know what we need to backfill, you know, by the end of a calendar year for that next season. So you can start to balance that out a little bit. The biggest variable is you always want to keep a handful of, at least for our parks, of kind of the day rate type people. So those are the people who are just traveling through town. Again, one of our properties is in central Pennsylvania, so near like the Poconos Mountains, and they'll just come in, stay for a weekend, and then continue on their road trip as they're maybe doing something like the Appalachian Trail from Maine down to Georgia with their truck and RV.
Mhm.
So you can drive revenue there, but that becomes a little bit more like the short-term rental. You don't count on it. It's kind of a nice bonus when it happens. And season to season, you see some
Mhm.
consistencies, but it's not all right, this month I have this many leases and this is what my money's coming in. It looks more like the hospitality business.
Mhm. So for our listeners, if you can just differentiate between what you said as an RV park and a mobile home park, can you differentiate a little bit what exact your main differences are?
Yeah, so there are certainly mobile home park providers. And to me, they are the home.
Yeah.
Think of you know, it's typically a ground lease, I guess, where they come and they buy
Yeah.
a mobile home and it gets parked there, and then they put the siding around the wheels, and it has its
Just stay
full,
there
year
forever.
round. Yeah,
Yeah.
they stay there forever.
Yeah.
I have some personal biases on
Yeah.
those. This is, think travel trailer. So the things you see flying down the highway, hooked up to a big truck, either a fifth wheel or just a travel camper that hooks up to the
Mhm.
hitch. Um, but a lot of people that own those park them in these RV parks. I'll call them near permanently. Uh,
Mhm.
so they kind of have their seasonal rent, and they'll stay there, and they can come at any point, back their truck up, hook up the hitch, take away the extra stands that kept it level, and drive away and go for a road trip with it, and then they come back and park it again. So
Mhm.
they are fully mobile at
Mobile.
effectively any time. And you hook up. They do have the sewer disposal and the water ports, so they can kind of hook into and the power ports to tie into our more permanent type stuff. Um, but again, I think of them as, at a very high level, mobile home parks are permanent homes. That's where
Yeah.
those people live 365 days a year. These are effectively generally cost effective, although some are very expensive, like second home, weekend homes that tend to
Second
be near the.
recreational home, I would say, right?
Yes,
Yeah.
exactly.
Yeah. Awesome. So now, have you uh, how the investors' expectation has changed, the priorities in the recent years, especially in the current economic state. Do you see any
It's
major fluctuation recently?
I mean, a big one is just a lot of people feel burned in this kind of syndication private real estate world. It was, what was it? The Jobs Act maybe that allowed, you know, things like this, the podcasts, and all of a sudden you could start market syndications on top of just
Yeah.
general understanding. Um, that all of a sudden you're seeing Instagram ads, invest in this apartment complex, invest in this mobile home park, this self storage facility, etc. And but we are going through a market cycle.
Yeah.
And I've been in this, as you noted. I mean, I graduated in 2007, so it's actually been close to 18 years now, that I've been in the commercial real estate space, or around the commercial real estate space. So we're not in anything unique, but all those people that came running in as every guru and every Instagram ad was, I teach you about real estate.
Yeah.
They got into syndications, typically in 2021 and 2022. And a lot of those deals, based on various factors, are not doing well. So that's the biggest one. I think we've kind of burned a small portion of the generation of people that were interested, that
Yeah.
might never come back in all reality.
Mhm.
Those that are still in it and or learned from that the last several years experience, it the questions are a lot different. It is a lot more risk adverse than it was. Everything was
Yeah.
opportunity back in 2020, 2021, even prior to that. Now it's, how are you hedging my risk, knowing that the projections, the opportunities, the returns might be lower.
Yeah.
I'm hearing a lot of investors that are saying, you know, I will only go into fixed rate debt type deals because I got burned on my floating rate debt. Are you paying my distributions with actual investment return cash flow, or are you just paying me back out of the money that I funded? And not to say
Mhm.
one is right or wrong, but like they're learning some of those things. How long are you
Yeah.
planning on holding this, and how much did you budget for CapEx? Was never really used to be a question because it just kind of worked. And
Yeah.
now deals are being held a lot longer than they originally anticipated. And there's CapEx items that maybe weren't going to show up in the first 3 years, but are going to show up in 6 years. And that 3-year deal has become a 6 to 7 year deal, and it's impacting their cash flow.
Yeah. 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 You're absolutely right. There are in the recent like past couple of years, there has been lots of ups and downs in this market with this interest rate going up. Uh, the cap rate not moving as high as it needs to be,
Mm-hmm.
so the seller's expectation hasn't come in line with the buyer's expectation. So hopefully now, it will get settled out with a little bit interest rate coming down. And it's not going to go way down as it used to be like 3 years ago, right? 2, 3 years
Yeah.
ago. But it will stay, hopefully it will, it might stay around between 5 and 6 at the most,
Yeah.
even if it comes down. But yeah, that at least that one moving part, right? Now you can hedge on and
Yeah.
then start underwriting the deal accordingly. So hopefully
Yeah.
now there will be some movements in the market, but let's wait and watch.
Yeah.
Yeah.
And I think it's interesting because you see a lot of groups, at least in this kind of sphere of influence that I've been in, that were only founded, if they've been around for 9 years, they're kind of like the senior
Yeah.
level groups. But having been in this space, even before it was called syndication, the first company I worked for, it was friends and family. The two partners and one of the dads and some of his friends bought their first deal. And then one guy didn't go into the second deal, but two other friends did come in. And, they just kind of grew that way. And it didn't have a name. It was just how you bought real estate back then.
Yeah.
But when I interact with these professionals that have been in it, 20, 30 plus years, it's interesting because a lot of them have just been like, I haven't been a buyer for 3 years. I've been focusing on my operations. I've been controlling my expenses, but I either have to change my investment principles, which I did in the early days, and I kind of skirted through and I had a lot of sleepless nights. So I'm not going to do that again. So I'll just be where I am. You're seeing it on those groups that have been around,
Yeah.
5, 6, 7 years now, that I think they are a lot more, many of them I see are a lot more risk off because it's the first real correction they've seen. And my
Yeah.
personal point of view is we're not done yet,
Yeah.
unfortunately. A lot of the economic policies, love them or hate them, there's going to be pros and cons in all of them, but every economist says they're inflationary, and
Yeah.
that's going to push up interest rates even further than they are. Um, the growth is going to be not there, which may keep that interest rate growth from happening, but it also means like
The
they're
rents,
not going to be able to
uh,
keep
rents
cutting
might,
because
yeah,
that would push inflation. But the term I'm hearing is stagflation. Many of us
stagflation,
remember it
exactly.
from 2008, but a lot of people who lived through it, and I've been to some conferences where I'm like, all these guys are 25 to 32 years old. They were in middle school in 2008. They don't know what stagflation is. They don't know what that's going to do to their rent and their
Yeah.
tenant base and all that stuff. And it's going to cause some more pain if you're staying aggressive on your acquisitions.
Yeah. No, absolutely. So now, in your firm, right, Axia Capital, as you mentioned,
Mm-hmm.
you are on the investors relationships side of the business.
Mm-hmm.
So what I understand is you partner with different groups or maybe operators and fund the investments. Is that the right understanding?
No, so we are internally managed. So I'm working with the actual end investor.
Okay.
Have we partnered with some fund of funds and kind of groups that are bringing in those actual investor relationships kind of through their own vehicles to us? Yes. Um, but we are primarily sourcing our own deals, asset managing our own deals. We are a relatively emerging company, so we haven't hit the scale yet where we've brought management fully in-house.
Okay.
Especially on our multifamily deals. We own the management teams on our 2 RV parks, but
Mhm.
but that's kind of where we are. And then my day to day is talking with those, those individuals primarily, that $100,000, $250,000 type investor that's interested in coming into our deals.
Mhm. So tell us about the strategy, right? Like in the investor relationship, how
Mhm.
do you build? How did you build uh, your investor funnel, right? What are the strategies that you have implemented to make sure new
Yeah.
investors flows in as well as the old investor sticks around?
Yeah. So the stickiness of the old investors. So we have historically been a 506B operator. So all of our prior offerings were 506B,
Mhm.
friends and family. And that's really just tapping into personal networks, people I've met over the years, people I'm friends with here and there, and the co-founders, the managing partners, their direct networks as well have funded us all of our deals up to this point.
Mhm.
Going forward, in fact, like I'm talking as of the day that we are recording this, in the next couple of weeks, we are transitioning to 506C for our next offering and going to be running more of the traditional marketing channels.
Okay.
Um, in my slightly naive experience, I've never been an attorney. I've worked with many compliance officers and outside counsels. I'd say we have our team at Axia is on the more conservative side, which isn't a bad thing. They keep you out of trouble. That's what I keep telling
Yep.
myself. But they've limited a lot of our ability to market, because you see other 506B operators that are out there still pushing out. They're not advertising their deal, but they are full blitz on the company.
Okay.
Um, and our compliance attorney said, yeah, but the reason you're marketing the company is to find investors, and therefore you're kind of breaking the rules. And that's fine. Again, it might put us at a slight disadvantage to finding investors currently, but it also keeps us well clear of any issues.
Mhm.
But again, going forward, we're moving to 506C, and you're going to start seeing, meta ads from us, as well as continue to tap into that network of investors that we currently have. Asking for referrals is always one of the best investor leads. And it all comes, then it becomes just customer service.
Yeah.
It's provide a product that people are happy in, set the right expectations that you can hit, if not exceed. And when you continually do that, it's, you know, people are thrilled. If you sell them on something that you can beat, then or even just meet half the time, people are
Yeah.
very happy. And I'm not saying we don't have like great deals. It's just interesting to me how I've met investors who are like, oh, I'm in this deal and I'm thrilled. And it's, value add multifamily that they bought in 2018. And he's like, I made a 20% return on this. I was like, oh, that's really good. He's like, yeah, over 4 years, I got 5% per year. And I'm like, that's not really that great in this space, but they set your expectation, they sold you something and you're thrilled with it. I'm not here to tell
Yeah.
you otherwise. Like that, they did a great job. Um, and so I view it the same way. If you just perform, communicate, all the typical things.
Yeah. And
Communicate, stay transparent, stay available, you're going to generally keep people pretty happy.
yeah. And I think this transparent part, right? That's the I think one of the most important aspect. Whatever the
It
situation is, right? Bad, worse, or whatever you're dealing with. If you're transparent with your investors, you tell them exactly what's going on in the background. They'll
Mhm.
have more trust in you, rather
Yeah,
than
and,
if
and I
hearing it from someone else.
yeah, and I saw it back in my early days, right out of college, because as I said, I graduated college in 2007. What
Yeah.
happened, 20 months into that first job, I got laid off because we're in the financial crisis. I was working in retail real estate, probably one of the hardest hit sectors, even if it was more necessity based stuff. And it was, you're always playing this game where like you don't want to scare investors and create panic when you don't need to. That's not good. But if you're trying to gloss over something intentionally or unintentionally, oftentimes, and then it doesn't pan out, then everybody's kind of pointing at you like, you didn't tell me that this was going to happen. So I personally take this stance of like, if things even start slipping, be very careful with your words, but start saying like things aren't going as well. They're below expectations right now. So that way, if in 6 months something drastic happens, this hasn't happened at Axia or to any of my LP investments that I've made, but if a property ends up going back to the bank, at least you've sort of prepared that for 6 months and communicated and tried to resolve. And it kind of lets you also get in front of the narrative. Here's what we're going to do to try to keep this from getting worse. All right, that didn't work. We're shifting, and I think people, while they might be upset, investors in particular, if they might be upset, of course, there is, like you said, a level of trust. Like you're not afraid to pivot. You're proactively trying things that, in your professional opinion, will resolve a bad issue. And again, you're kind of seeing it as over the last few years, as groups with stellar reputations became less stellar. Even when groups that have the same, because of their communication, even though other groups, same space, same problems, deals not performing as expected, have maintained their relationships because they've been probably overly transparent and were willing to take some of those. There's no such thing as overly transparent. I take that back. But they've been fully transparent and just kind of willing to take those lumps as it might cause a little bit of panic for certain investors. But at least those investors can't say it pulled the rug out from under me and I didn't know this was coming.
That's absolutely true. So now, you have been in real estate for quite some time, right? Can you give us maybe one example of any one of the bad situation or, worst situation that you came across, and how did you handle that?
I'm going to kind of take a bit of a cop out because I'm racking my brain right now. The worst situations are really just the deals I was afraid to do, in all reality. I consider myself a fairly skeptical investor. And so it takes a while for me to get into any deal. So and this is both my active, thinking back to my single family, rental type properties. The one that always comes to mind was early in my career. I bought my first single family rental in 2010. And I bought a second one several months later and held those for a year to refi, because at the time I only knew like you have to have 12 months of seasoning. It was the Burr model, again, kind of before Burr had a name. And I was sitting on a lot of cash, and there was a 40-unit apartment complex in a neighborhood I knew that went for sale, and I had enough cash, like not to buy it in cash, but close. Like I could have gotten a 50% loan to value. And it's probably the biggest regret. So again, it's not the worst deal I ever did, but it's the worst deal I never did. Because my mentors were all single family rental owners at the time. And I was like, I own 2 rentals. What am I going to do with a full-time W-2 job, 2 rentals, and now I'm trying to buy a 40-unit apartment complex? So it really came down, I'd call my fault as not trying to educate myself more and look outside of my circle to figure out how to get that done. Because again, hindsight's always 2020. It's been 15 years. That property was for sale for $400,000 for 40 units in a good neighborhood. If I had to guess, it's probably worth $6 or $7 million today, just given the growth of that neighborhood and everybody wanted to live in it. And it's like, well, darn,
that's what.
Wish I had thought to research this a little more. Oh, there's management companies that can do this for you. There's, different ways to get it done. But that is one of the values of all the internet is you learn about that stuff a lot easier than even back 15 years ago.
Yeah.
Personally, it's my LP investments. I'd say it's the floating rate debt stuff. You just kind of suck it up. You don't invest more than you can afford to lose. Not that I want to lose money, but there's a couple deals that I am fairly certain I won't see any money of mine back. And it was a bit of having been in it long enough, having gotten laid off during the last run up back in 2006 because of poor acquisitions. You still kind of get into that excitement, and you're seeing these deals, and you jump in. I jumped in 2021 into a couple deals, and like they're not sure losses. They haven't been sold yet, but leaning
Not as expected. Yeah.
And leaning towards hey, we've got big interest rate cap replacements that we need to do. We're selling this deal. We are going to turn a little bit of a profit, but like that's getting funneled back into these other deals here. And it's mentally, it's sort of that hope for the best, but at this point it's sort of that money's gone, and if I get any of it back, I'm happy. Just change those expectations.
Yeah, hope everything works out, man.
Well,
yeah, but you never know, right? These are all investment. That's why there's an asterisk star. Be prepared to lose everything. Of course, we're gonna try make sure you get the expected returns, but the landscape might change anytime. You never know.
Yeah.
Right.
And kind of dating back, or kind of hopefully this is a feedback for some of your listeners, is I've spoken with investors who got in with an operator. They were kind of piecemealing it, and they started kind of focusing in on one as that one operator kept performing. And then it's might not be performing. And now they're sort of like, I've got lots of money tied up here.
Yeah.
That it might all be gone. Who knows? So
that comes with diversifying, right? Just don't keep all the money in the same basket. That's what people have been telling all along.
Yeah. It's just know the risk, and I've phrased it another way, like know the risk you're taking. Because it kind of comes back to that first point with the apartment complex I didn't buy. It's just because one person, everybody, what's the term? We all, humans by nature, move in the path of least resistance.
Yeah.
And so it's easy. Hey, did a deal, they did great. Did a second deal, they did great. Did a third deal, fourth deal, fifth deal, they did great. Eventually, it's not going to run great. And anybody, and like that's not a dig on any operator. If you're in the business long enough, you're gonna miss. Like no batter in baseball, and I'm not a big baseball fan, bats 1,000. Like it's just not realistic.
That's
so don't like that would be the advice, is just even when one group has been, they're kind of the easy, they've always got a new deal and they've always performed in the past. It's like, but it's not always going to. And it's not because they're a bad operator. It's just know that you can't keep concentrating that risk into that one operator just because for 5, 7, 10 years they've always performed for you, unless you're willing to take that loss. And it might happen.
Yeah, there's no guarantees. Right? Yeah.
And then taxes and death, I think, is the phrase, right?
That's true. Yeah. All right, Ivan. Loving this conversation, but I also want to be mindful of your time.
Yes,
so we'd like to move to the final round of questions. Are you ready?
Okay. Yeah, I am.
All right. So the first one, which is the one book that had the most impact on your life or on your business?
From a professional standpoint, Principles by Ray Dalio. You saw my eyes shift down, so I made sure to quote it all correctly. But I've loved that book. It's about life and work, and kind of his approach to balancing the two and creating, great outcomes in both, together.
That's right. Yeah, that's a good read, of course.
Yeah, it's not some out of left field one, and it's probably been quoted more than a dozen times, maybe even on this podcast.
Yeah. All right. What are your main source of information to learn and grow?
I like podcasts. I like the news. I'm an avid Apple News and news radio listener when my kids aren't in the car. And then I try to balance my reading because I tend to default to fiction, which I think has its own, place and it helps me fall asleep at night. But, just like books, I like longer form stuff, not just the snippets, especially if I'm trying to like change a mindset or move into a direction that I'm not there. Like having that long form really helps continually push in that direction.
Yeah. Right. What is the one habit or routine that has been crucial to your success?
The one I like is becoming a morning person, which means I go to the gym at 5:30 in the morning. So it gets it out of the way, gives me the energy to kind of charge with the day, and all the things with exercise. But the gym I go to is a class form. So like there's a 5:30 to 6:30 class, and it just makes me get there. I get to know the people, and that way I'm not slacking at the end of the day. Like I didn't get to the gym and now I've got an extra thing to do and this and that. And as noted, I have 2 kids who occupy basically every hour from the end of the workday until bedtime.
Yeah, I hear you, man. I got 2 little ones also. Like not a little ones. The one is a teen now, but yeah.
And they still
All
feel
right.
little. Mine are 10 and 7, and so not quite a teen yet. Sometimes the attitude says otherwise. But they make life fun. Sometimes they make it really frustrating. But most of the time they're fun.
Yeah, that's it. That's it. All right. Final questions. How can Decoding Cash Flow listeners get in touch with you?
LinkedIn tends to be the easiest. My Instagram is personal at the moment. So I just direct everybody to LinkedIn and send me a message there. I'm good at following up with those. And from there we can take it off LinkedIn, but I forget I sent the whole URL, but LinkedIn, Evan Polaski, I think I might be the only one. And send me a message.
Sounds great, man. It was a pleasure having you on the show.
Yeah.
And we'll surely stay in touch.
Certainly will.
All right. Thank you.
Thanks for listening to Decoding Cash Flow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cash Flow, and we'll catch you in the next episode.